So we'll go ahead and get started officially, and I'll start this as I typically do with a very sincere thank you to each of you for joining us today. We've got Paul Johnson on tap here to talk about investing skills you need to succeed. I'll introduce Paul in just a moment. For those of you who don't know me, I'm Bob Schmidt, Executive Director of the Brandis Center here at UC San Diego's Rady School of Management. The Brandis Center is one of several research centers on campus. What we're trying to do is share advice through research that we provide through forums such as this to help make institutions and individuals better investors. I mentioned this a little earlier. I'll repeat it as well. Looks like everybody has muted themselves, which is great. I want to eliminate any background noise. At the same time, we've structured this loosely, 30 minutes for comments from Paul and then 30 minutes for Q&A. So if you've got a question, feel free, unmute yourself or pose the question in the chat. Again, we want to make this as interactive as possible. So I want to introduce Paul. He's an adjunct professor at New York-based Fordham University's Gabelli School of Business and executive director of the Gabelli Center for Global Security Analysis. He also teaches at Columbia Business School, including classes in securities analysis and value investing. He's been recognized at both Columbia and Fordham with various awards for his teaching excellence. He's a co-author of the book, Pitch the Perfect Investment. I'll hold up my copy here on screen. And I'm highlighting this because I know he's going to talk about this today. Paul earned his MBA in finance from the Wharton School and his BA in economics from the University of California. So it's great to welcome back a UC alum. And with that, Paul, I will turn things over to you, my friend.
Excellent, Bob, and thank you for inviting me. I really appreciate the opportunity to present to everybody. As Bob said, I'm going to run through kind of 30 minutes of quick introduction on one of the aspects I think that's very important and underserved aspect of the investment business, and then I much prefer the Q&A. We had some questions sent in, so I may start there unless there's questions. I'd rather do live questions with the people that showed up. And I did send a copy of this presentation to Bob, and you're all welcome to it. If you reach out to him, he will send you a copy of it. All right, so without further ado, as Bob said, I published this book. It's just frightening for me to realize that this was now 8 years ago, almost 8 years ago. It feels like it was a lot sooner. It took forever. The book took about 4 years to write, which is crazy because we told, I'll come back to that. We told our publisher that it would take 18 months. We missed that deadline by a lot, but most books do. I'll get to the very quick story behind the book momentarily, but the covers you'll see, the blue cover, my co-author Paul Sonkin and I we both like blue, but this is mapped off of a Fortune magazine from June 1937. I love the fact that it's $10 a year, slightly more today. But you can see that ticker tape, and Paul always loved this cover. He thought this was spectacular. There's actually a picture of my copy. You see in the trim, you see a little bit of hardwood floor. I put it on the ground and tried to take a picture of it. But you can see we copied that onto the book. The book is really structured into 4 sections. I only want to walk through it because this sort of structures my talk today. Kind of the first section is on value. The second section is on price. And if you are an active investor, by definition, you believe that price and value can deviate. That's a really important insight. The third section is on risk. Writing the book, I realized this was many of the aha moments of writing the book, that the risk and research are the opposite sides of the same coin, which I thought was kind of cool. And then finally, the 4 sections on the pitch, and I'm going to talk a bit about that today. The reason the book took so long to write is that we realized halfway through we didn't know what we were talking about, and that we probably should figure that out. We had written a fair amount first year, and then really realized that we had not, even though I had been teaching at that point for 20 years, well, more than that, almost 25 years, and Paul had taught for 17, pretty successful course. When you go to write, you realize what you don't know. In fact, my favorite quote about writing is, it's God's way of telling you don't know what you're talking about. And so we finally sat down and we remapped it out, and the book was the result of that. All right, so here's sort of the first thing you should understand about stocks. Number one, they're narratives. We teach investing with a financial lean. We teach it from valuation, sometimes market-related thing. Obviously, we talk about risk, but at the end of the day, they're stories. Stocks are stories. And the story is a narrative we talk about, and I'll make this point again near the end of the presentation. But stocks effectively is they're an estimate of intrinsic value. That estimate of intrinsic value is a narrative, a story we tell. And stocks move around as the stories change. Now, the good news is that those stories, those narratives can be modeled as a DCF, and that's an important insight. And price, market price, is a consensus of all narratives. Sort of hard when you first hear this, kind of hard to conceptualize. But as you start to play with it, you realize it's a pretty good frame. They can be modeled as DCF, and we certainly teach financial analysis, an important part of it. But at the end of the day, they're stories, and the price is kind of the consensus of all those narratives, all the stories we're telling each other. All right, so now let's talk a little bit about stock prices and why they move around. So we do know, this is truth, that value of any asset is the present value of future cash flows discounted back for time and uncertainty. The way it's taught in business school is they say time and risk. That is incorrect. It's time value of money and the uncertainty of getting those cash flows in the future. That is discounted back to today. It's discounted back to today because dollars today are more useful, more valuable than dollars in the future. So if that's the value of an asset, by definition, the value of a company would be exactly the same. It is the present value of the free cash flow that business will generate over its useful life, discounted back to today. That's the key. So the stock price, as we know, is an estimate of value, and it's an estimate of the present value of all those free cash flows. That's important. But we don't know what the free cash flows are. We don't know what those cash flows will be in the future. Therefore, they're actually a set of expectations related to those cash flows. So stock price, the definition of a stock price is the consensus expectations of future cash flows discounted back to today. That is the definition of a stock price. It is a set of expectations that investors have come up with for those future cash flows. All right, so it's expected future cash flows. Now, the key is that we don't know what it is. It's a set of expectations. So price is a consensus estimate of value. It is a consensus set of expectations. So if a stock price changes, it's because investor expectations have changed. So this to me is probably the most important lesson to learn as an investor. It'll certainly be the most important comment I make today, which is that stock prices are a set of investor expectations. Stock prices change because investor expectations change. What is the goal of investing? To anticipate that investor expectations about future value will change over time. If you buy a stock, it's because you fundamentally believe that the current set of expectations about the future are too low. And you believe that over time, the rest of the world will figure out that those expectations are too low. Those expectations will go up and the stock price will go up and you'll make money. So investing is, in a weird sort of way, arbitraging today's expectation versus a future set of expectations. And what fundamental investing is trying to use fundamental analysis to anticipate changes in future investor expectations. That's the key. All right, so stock prices change because consensus expectations change. Stock prices go up because expectations on future cash flow go up. Prices go up because estimate of value goes up over time. One more time, we use fundamental analysis to try to anticipate that change. That's the essence of investing. All right, now we do need to separate fundamental investing from speculative investing. So fundamental investing is an asset has a fundamental or intrinsic value, which is almost always based on future cash flow. That's what we've been talking about. Now, the good news is with fundamental value, you can determine an investment strategy. If price is less than your estimate of fundamental value, you should be interested in buying it. If price is greater than your estimate of fundamental value, you probably shouldn't own it, maybe even sell it. All right, so the good news is fundamental investing has this sort of North Star. this placeholder that we can use to evaluate whether we should buy or not buy. Speculative assets do not have such great tools. Speculative assets are any asset that does not have a fundamental or intrinsic value. So think Bitcoin, think gold, think copper, think all of those kind of commodities. They don't have cash flows attached to them and never will. Therefore, they don't have a fundamental value. So they're speculative assets. Nothing wrong with speculative assets, just important to understand the difference between those. The problem you have with speculative assets is you don't know your investment, you don't know what to do from an investment perspective when the price changes, because you're speculating on price changes, but there's no fundamental value as a reference point. So if the price goes up, do you buy more or sell? Don't know. If the price goes down, do you buy more or sell? So the challenge with speculative assets is developing an investment thesis around them, because it's really based on just price. You have no benefit. So fundamental assets are, I will argue, functionally easier to deal with, and they have a more systematic approach. All right. Now, Ben Graham, the great grandfather of fundamental analysis, value investing, he said this great quote: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. So the way you want to think about it is the following. The primary stock performance driver, if it's speculative, then it's a shorter term holding term. So meaning that stocks move around, short-term movements in stock tend to be speculative in nature, not 100%. Whereas over time, stock performance is almost always driven by the fundamental value, the fundamentals of the company. So when I think about it, so the shorter your holding period, the more you're in the speculative world. The longer your holding period, the more you're in the fundamental asset world. Really important to understand. So that's a function of your holding period. All right. Now, I will argue that investing is a supreme act of arrogance, because every time someone buys a security thinking it will outperform, someone else is, by definition, someone else is selling that security because they believe it will underperform. There are two sides to the trade. You're focused on your side, but you really should stop and ask yourself is, why was somebody willing to sell to you something that you think is of such great value? That's really important. And the bottom line, pretty simple, is one of these investors will be wrong. So you have to ask yourself, why do you believe you're on the right side of the trade? That's why I call investing a supreme act of arrogance, because you fundamentally believe you're on the right side of the trade. You better ask yourself, is that true? And why do I believe it to be true? Charlie Munger passed away a year ago, a little over a year ago, Buffett's long-term partner. His comment on investing: it's not supposed to be easy. Anyone who finds it easy is stupid. This is a very challenging business. All right. Now, let's say you come up with a great idea. You've done all your work. You really do believe that the stock is undervalued. Failure to get that idea into a portfolio, yours or someone else's, is no different than having no good idea. You got to get it into the portfolio. And a successful pitch, in my mind, is key to overcoming that challenge. Now, analytical skills will get you the job interview for sure, but pitching skills are going to be critical for your career. So I like to think of it this way: the overlap. You get the job. Your analytical skills are the most important tools. Your pitching skills will become incredibly important for you to keep your job, receive a bonus, and get promoted. When I go talk to portfolio managers, I always say, what's your biggest frustration with your analysts? He said, they cannot pitch to save their life. And I said, well, what's the net result? He said, we don't get names into the portfolio. They get frustrated. They don't get a bonus. They don't get promoted. They want to move along with their career. And they will always say to me, I thought you wrote a book on pitching. Can you go teach these kids how to pitch? I said, doing my best, doing my best. All right, so let's talk a little bit about pitching. All right, there are three aspects to every pitch. I don't care whether you're selling perfume at a department store or Sephora, you're selling real estate, you're selling private jets or big boats. It's all the same. You have three pieces: what you're selling, who you're selling it to, and how you're approaching that sales. In the investment business, what you're selling is the content. It's the idea that you're selling. The audience is the portfolio manager, and the delivery is how you're going to convey that message clearly and succinctly. All right, content. Why is the idea attractive? There's 4 questions you have to fundamentally answer in every pitch. Most people don't even know about the 4 questions, let alone to answer the 4 questions. But here are the 4 questions. How much can I make? How much can I lose? Why is the market wrong? And how will the next person figure it out? That's the four questions you have to answer. And you have to answer all four of them, right? So how much money will I make? That's the upside. Why is the stock mispriced? How much are we going to make once the world figures it out? How much could I lose? That's the downside or risk of being wrong. Those are two very different questions. They both need to be addressed. Why is the market wrong? And at the same time, how did you figure it out? Whenever I hear a young analyst say that they're recommending a stock, I always say, how long have you followed it? A couple of months. And how did you figure this out? A good friend of mine in the business always says, why, oh Lord, why me? And that's the key. So how did you figure it out? And then we need the next person to figure it out. So that's your catalyst, because we need the price to appreciate. So those are the four questions. By the way, this is the only question that matters. Why is the market wrong? And if you cannot answer that, then maybe the market is not wrong. But that's really the key that you want to get to. And where you go from a junior analyst to a senior analyst is being able to answer this question. This is really the most important question. All right. So now, if your holding period is sort of shorter and you're in that speculative realm, what you're looking for is an informational advantage. You're trying to find things out faster than the market. If you're spending your time in the fundamental world, longer term holding period, you want an analytical advantage. You're trying to determine that value better than the market. So informational advantage, trying to figure things out before everybody else in the market. Analytical advantage is you're trying to just be more accurate in that long-term estimate of value. That's the key. All right, so that's content. Why is the idea attractive? Answer those four questions. How much can I make? How much could we lose if you're wrong? Why does the market think what they think? Why is the market wrong? And what's the catalyst? How's everyone else going to figure it out? What's going to change their mind? Audience. The key here is the portfolio manager. And your job is to try to match the PM's investment criteria. All right. So as an analyst wants to present ideas that the PM will listen to. He wants the PM to adopt their ideas, and he wants the PM to scale their ideas. That's the key. A portfolio manager wants new ideas they feel motivated to listen to, wants to adopt ideas that will outperform, and wants to scale the best ideas in the portfolio. So here's the key, right? We've got listening, adopting, and scaling. So listening requires matching the PM's objective criteria. So if the PM says, I only invest in North American stocks, don't bring them a European listed stock. The PM says, I only invest in companies over $1 billion. Don't bring them a $500 million market cap. If the portfolio manager says, I don't invest in banks, pharmaceutical, or high growth, high tech, don't bring them NVIDIA. That's the key. So that's their objective criteria. And they will listen. If you're in their sweet spot, they will listen every time. Adopting, you have to match their subjective criteria. This is bloody hard. Subjective criteria is really pattern recognition of stocks they've made money in before. You'll never do this in an interview. You probably won't do it much early in your career, but over time, you'll start to understand that the big boss, that she likes certain kinds of companies. And you start to find companies that fit her subjective criteria. That's their experience. So objective criteria is sort of the mandate of the fund. Subjective criteria really is against her experience, where she's made money before. It's kind of a pattern recognition. And then scaling, you have to actually transfer ownership of the idea from the analyst to the portfolio manager. The portfolio manager has to feel as comfortable telling the story as you do. And that is frightening for some analysts, because they feel the moment they give up ownership, guess what? They're not going to get credit. And they're not wrong. It's a serious issue. But if you want to be able to scale ideas into the portfolio, you're going to have to transfer that to the portfolio manager. All right, so here's the key to this successful pitch. Keep it simple. The best analyst can always boil the investment idea down to 1, 2, or 3 points. If you need 4 or 5 to make it work, it will never work. The probability is just too low. So keep it simple, both in your presentation and in your investment recommendation. It's easy. Apple's primary, if you're going to be interested in Apple, you got to figure out how they're going to grow again. It's got to be driven by new product. Chipotle, it's all comes down to how many stores they can open and cannibalization. Nichols had just arrived at Starbucks. He's got to rationalize everything and reduce costs. Uber, they got to figure out the discipline. Amazon, they got to see how big is that total available market, right? So all investment, the good investment ideas come down to one or two or three sentences. You also want to focus on the four questions. How much money can I make? How much money can I lose? Why the market is wrong? And what's the catalyst? And the idea is to show the PM how they'll make money with the idea. Doing this is hard. It takes a lot of experience and a lot of reps, but this is the goal that you're trying to get to. Now, as I said earlier, all stock pitches are narratives. We are wired to like stories. We're story animals. And so all stock recommendations play to those stories. No one ever went on CNBC and said, my DCF value, using a 5-year explicit and a 3% terminal value growth rate, 8.5% discount rate says the stock value, the value of the stock is. No one ever. They tell a story. What market doesn't understand this? The company's going through an evolution, new management team, growth's going to continue, blah, blah, blah. And so you want to find the narrative behind the stock you're pitching. Not easy to do, requires a lot of experience, but best way to do it is get started. That's the key. Second thing, tell a story, number one. Second thing is co-opt your audience, get them involved. And one of the things I see in a lot of analysts is they'll prepare a presentation. It could be 10 pages, it could be 20 pages, 30 pages. And on page 1 or page 2, the portfolio manager interrupts and the analysts get frustrated when in fact, that is what you're aiming for. You want them to get into the question. And the reason is they're trying to map your work to their subjective criteria and you want to let it go. You just want a very quick statement. I'm recommending the stock. I think it's undervalued for these 3 reasons. And then you start and the PM start asking you questions. That is good. Don't get frustrated and lean in. They are starting to take ownership of the idea. They're starting to see if they can tell the story themselves. Really important. And then the third piece is separate what you know from what you think. We can debate thinking, we can't debate knowing. So you want to say up front, I see analysts do this all the time. I think the stock's undervalued. I frankly don't care if you think it's undervalued. What I really care about is the work you've done. And if you tell me that we're doing work on Starbucks and we just talked about, and what you've done is you've talked to managers of 13 restaurants in the Northeast, 2 on the West Coast, I'm going to say, what did they tell you? That's interesting to me. What did you know? And oh, by the way, when I model this, if they hit their margin target, guess what? The stock is still not cheap, right? Those are the things that you've done, you know. Then we can get into what you think. And it's very hard to argue fact. So focus on what you've done, the work you've done, what you know to be true. All right, I'm going to talk about 2 different times where you're going to pitch. Pitch competitions and the biggest mistakes made. Number 1, the slides are always too dense. Judges can either listen or read, but not both. Don't make them choose. And by the way, they're generally going to start reading. So if you put up a slide that is very hard to read with a lot of bullet points on it, you're going to lose your audience. They're going to stop listening. Now, if you want them to read it, stop talking and tell them to read it. Even better, hand it out to them so it's right in front of them, they can read it. So I would say that's the number 1 mistake. And I see that probably 100% of the time. Slides are way too dense. And I understand it because the analysts, the students have done a ton of work. And what they want to do is show the PM that they've done a ton of work. And I understand that. But when you get to a pitch competition, you got to the final because you've done a ton of work. Let that go. Very hard to do. Number 2 mistake is not answering the 4 questions, particularly why is the stock mispriced? And if I ask you, I do a lot of these pitch competitions. When I ask you, why do you think the stock's mispriced? So you can't answer that. Then I'm going to say, well, maybe it's not mispriced. So you want to focus on that one. Third mistake, attempting to answer questions when you do not know the answer. And I will tell you this, in the business, PMs have an amazing BS detector. Unbelievable. So you start winging it, I know it instantly. So all you have to do is say, I don't know, which apparently is hard to say when you're young. Don't worry, you'll get better at it as you get older. I say it all the time. And you can also say, I didn't know that was important. And you'll get one of 2 responses. The PM will say, no, it's critical, and you've just learned something. Or they'll say, no, it's not that important. I was just curious. And then number 4 is poor time management. If they give you 10 minutes, end at minute 9. No one in the history of the world has ever left a presentation or a speaker or anything and said, boy, I wish that had gone on longer. So use that to your benefit. They give you 10 minutes, use 9. They give you 5 minutes, use 3.5. Tighten it up. Use less time than they give you. Allow more time for Q&A. All right. The second time you're going to pitch is an interview. And interviews in the investment businesses are all stock pitches. They may say things like, how do you like UC San Diego? Or how do you like living in San Diego? Or whatever they'll ask. They don't really care. They're just trying to pretend to be human. And then they're going to say, what do you own? What do you like? And you should be prepared. Now, you're never going to know their subjective criteria by definition. And you can't have a different stock idea for every interview. That would be just way too much work. So what you say at the beginning of the interview is, I am pitching this idea to show you the work I'm capable of doing, the work I've learned how to do, not as an idea for your fund or portfolio. Because you need to get them out of their natural mode of being a PM. And the moment they hear it, they say, I'd never buy this stock. No. It's not for your portfolio. I don't even know what you put in your portfolio. I just want to show you the kind of work I can do. You want to neutralize it. And the moment you do that, they're going to shift how they listen to you. So that would be my advice. All right, final topic, credibility. This is a business where credibility is key. If I am looking through your model and I see you've made a mistake, I panic. Why do I panic? I panic because I don't know what other mistakes are on the model, and I don't have the time to vet your model. So you've got to maintain that credibility, establish it early, and maintain it throughout the pitch. Really important. Answer the 4 questions. That's key. All right. And then small, careless mistakes will undermine your credibility, and big mistakes will end the meeting for sure. And the reason is the human brain cannot unlearn very well. It is a neural net. We're all learning a lot more about neural nets these days, but the brain is a neural net. And once you fed information to it, you cannot undo it. And you have a physical change every time you hear something new. It starts to alter your brain a bit. It's hard to undo that. So the moment I realize that your work is not of high quality, I want to stop the interview, stop the presentation, whatever it may be, because you're polluting my brain with untested information. So maintain that credibility. That is critical. But at the very end, do not try to sell me. You're just trying to present it in a way on why the market is wrong, why there's more upside than downside, why there's a high probability this will work out. You have an information or an analytical advantage. Show me that, but don't try to sell me because it drives me crazy. All right, almost done. Wow, I did it in time. I do have a YouTube series called The Value of Growth, easy to find. I think this week is lecture number 27. I don't know, 26, 27. I have 3 more. I think I'll get to about 30. If you're interested, it's free. It's pretty good stuff. It's essentially the course I teach at Columbia Business School, where they charge you, what do they charge per class? It's like, I think the official term is a shit ton of money. So you can have it for free. So I'll leave that up. Bob, I'm done with formal. I told you I'd get it done. Open it up to Q&A.
Okay, Paul, thank you so much. One thing that occurred to me, just to make sure we're all on the same page, what you're sharing here is how the investment industry, the investment management industry tends to work.
Yes.
Your first job might be as an equity analyst or a fixed income analyst. And as Paul said, you're going to do all the analytical work, and then you're going to share those ideas or pitch those ideas to your boss. And your boss is going to be a portfolio manager. Might be one person, might be a committee, but the fundamental analysis, that's one part of it. The larger part, or an equal part, is selling or pitching that idea to others. So what Paul laid out here, I have seen over 30 plus years working in the business, and this is critical. And for those of you who jumped in late, or maybe I didn't explain this in the beginning, I teach at the Rady School communication classes, and a lot of what Paul is sharing, I share as well. So before I go rattling on, let's pause. Any questions, please, please, please feel free, unmute yourselves, ask any questions. We got a ton from people who registered, so we got a lot to go through, but I want to open the floor to any questions from anybody who's on the line live with us right now.
The one thing's up if people are shy.
Yeah, you could use
Is my mic working?
Yeah, we can hear you. That's great.
Hi Paul. Nice to meet you. Sorry my camera's not working. But I really appreciate you coming here. I would love to hear actually a little bit more on your teaching experience over the years, since you've been teaching at Fordham and then CBS as well. I'm personally very interested in the Value Investors program at CBS, though I'm only a junior here at UCSD. I would love to hear like what lessons have you actually learned yourself after like teaching and being involved with like this program for many years? Since I'm sure there's many takeaways as being a professor, but how about being like a student of your own teaching as well over time?
Yeah, no, good question. Now, just to set the fact pattern a little bit, I've been an adjunct at Columbia for 32 years. Started in fall of 1992. Um, and I've been an adjunct at Fordham for 9 years. So I've spent more time at Columbia than here. The Columbia program is pretty amazing. I was at an event a week ago or something, and they said that they now have 45 adjunct professors in the value investing program generally. And it covers everything from credit to equity and everything from research techniques to value investing. It's an amazing program, overwhelming. Um, I would say the next closest business school probably has two or three classes. So even if we cut our program in half, it's still an order of magnitude larger than. So if people are interested, it's definitely the place to go. Now, it's not cheap, I will tell you that. And I would recommend you work a couple of years after undergrad before you go to business school, since you'll be a bit older and more appreciative of you have a better content, all that. So I would say at Columbia, it's overwhelming. I think most full-time MBA students get there and they're now instantly looking for a job. That's sort of the challenge. So the balance of finding a job and the work is, I think, the trick is how you can do that well, because you literally could, you're required to take 5 classes a term, 2 terms a year, but you easily could take another 5, audit or sit through world class instructors. And you're going to have to learn to balance all that. You get out with easily the best investing education available on the planet, although there's an enormous number of free resources that are available to everybody. I put my course online. There's no reason to fight it any longer. I think the people love it. The people that really lean in absolutely love it. I have a lot of former students that just think it's absolutely a wonderful experience and really trains them well for their career.
Andre, did that answer your question?
Yeah, perfect. Thank you.
Okay. Others from folks online, any questions? Feel free to unmute yourselves and chime in.
I'm tempted, one of the ones. What do you expect a new graduate student to have when you are hiring? I love this question. Also, one is what skills are critical to the future? Similar question. A couple of things. There's sort of kind of generic traits and then specific skills. Generic traits, I'm looking for somebody who's curious, disciplined, hardworking, of course, and passionate. I want somebody who really is. I use a phrase that always upsets people, but I haven't come up with a better phrase. But um, the people that survive in this business are junkies. They're the people that can't get enough of it. I know, Bob, you were around them. It's just they think about it, they read about it, they talk about it, they write about it, and then they do repeat. But I suspect that's true in every business. I suspect that's true in music, acting, athletics, medicine. The people who are most successful are the ones that really love it. So if this is something you're incredibly passionate about, show it. Don't be shy. It's hard to get in, but it's hard to be a top-notch doctor. It's hard to be a top-notch musician. It's hard to be a top-notch actor. So it's no different than any others, but show that. And so that's kind of what I'm looking character-wise: curiosity, discipline, integrity for sure, passion, hard work, all of that. And then skills. Look, in the business, accounting is probably most important. When I was an undergrad at UC Berkeley, my father, who was a tax accountant, said to me, take as much accounting as you can. And I was a finance major and looked down on accounting. And I said, ugh. And I took 5 accounting courses and didn't love them, but glad I did, because in business, accounting is the language. So you don't have to take 5, but you've got to do enough that you could run around a balance sheet and income statements. That's really important. I would say a little bit of finance, but I don't think finance is as important as accounting. I can't believe I'm saying this all these years later. That was my dad's advice. I think those are key. The skill set, Excel and PowerPoint, critical, but you all have that. And now a new one, and that's AI. And I would argue that you really have to understand how to use the AI tools. If I asked you to do a financial analysis, set up an income statement, you would do an Excel spreadsheet. You wouldn't do it on paper. When I started in the business, show you how old I am, I had senior analysts that did all of their models on paper with pencil and eraser. And I came along right as the spreadsheet came along, and I was building models on the spreadsheet, and they thought I was crazy. I think AI is the same thing. Cliff Asness, who runs AQR, said that he thinks 70% of the analyst job can be done with AI. My retort is, which 70%? I'd like to know that. And I really do think it is a tool. So you should, independent of whether you're using it to cheat in class, I don't care. But you really want to start to use these tools and understand what you can and can't do with them. And if you come in my office and you understand accounting and enough finance, and you know how to build a model in Excel, and you know how to download things from there, and you're good at this AI thing, you get the second interview.
Hey, Paul, on that front, in your career, where did you learn most of your skills? You had mentioned accounting, you mentioned finance, you mentioned AI. Did you learn those skills in college or on the job?
Yeah, I love the question. I would say the basics were learned in class, and then in the job, you really learn what's important. I think if you put a gun against, I do love my wife. You put a gun against her head and ask me, the only way I'm going to save her life is to explain lease accounting. I'm going to have to look at her and say, I love you dearly, but sorry about that. And probably the same for tax, deferred tax, and things like that. But I know enough accounting that if I needed to learn, I could go and read about how to do it and come up to speed very quickly if I needed it. But I can also look at a balance sheet and income statement and show you that there's a typo or something very quickly. So you want to, but that's that rep. So you want to know the basics. You want to be able to go and read if you needed to figure it out. I think that's important. But I would say almost all of what I've learned is on the job. And that's the key. Is you want to take any job, but almost any job you get into the business and start doing the reps.
Yeah. And I'll ask one more question and then we'll open it up again. Dr. Vincent Nyes here at UCSD has often said, you're not going to be replaced by AI. You're going to be replaced by somebody who knows how to use AI.
I love that line.
You mentioned AI. Is there anything specifically with AI that you would recommend that students are looking at, learning how to apply, et cetera?
Well, I was thinking about this the other day. AI today, to me, is where web pages were in the mid 90s, which is, anybody that could put up a web page was valuable because people didn't know how. But within a few years, a lot of people learned how to do it. So we're at the very beginning, and we're not sure what the tools are. It's clear that the key to AI right now is prompt engineering. And I'm trying to play with that myself is, you ask a question, you get back. The part about AI that's really fascinating is you can ask a follow-on question and it remembers the first question. So you don't have to retype the first question. You're having a dialogue. It's almost like working with an assistant and said, so the other day I wanted to do something in Excel and it was like, I didn't know how to do it. And so in the old days, you watch YouTube or something. And so I just said to ChatGPT, could you create a spreadsheet that does this? And it did, but it wasn't what I wanted. I said, oh, I'm sorry. I didn't say I'm sorry. I said, adjust it this way. It did. And I said, oh, wait, put the formulas in the cell because it was just giving me the number. Oh, okay, put this out. And I said, oh, wait, format it this way. And I kept going back with it and it remembered that. And by the end, I had the spreadsheet I wanted. And that to me was pretty cool. I like that a lot. I'm in my spare time, I run a publishing company and we're trying to come up with a new author-friendly contract. So I fed it a bunch of old contracts and I said, make this author-friendly. And it did. And I said, well, wait, add this and this. It did. And it did. Finally, I got a draft I really liked and I just kept iterating it, almost like you're talking to a young lawyer. And then I sent it to my lawyer, the corporate lawyer, and said, this is what I'm thinking. And he looked at this is pretty good, but let me tweak it a little bit. Now, I did it just to learn and to see, but I also saved myself a few bucks. That wasn't really the goal because he's not starting it with a fresh draft. He's editing a document. So it was going to be 2 hours of work instead of 4 hours of work. So I think that you should be using AI every day. And if you use Google every day, you should use AI every day. Now, that's generic. We're starting to see financial tools come out where people are putting front ends. And now all of a sudden you can say, hey, every company in the restaurant industry, give me their commentary on same store sales over the last 15 months on a quarterly basis. And it will literally list out every one. And you can start to look at it and say, all right, rank these by the most bullish to the least bullish. Boom. All right. Link these to the ones that had upside surprise in their earnings. Boom. All right. Now do the so that's what I think Cliff Asness is saying. Now, those tools are expensive, as they should be, because they're new. But the more you work with generic AI, the more you're going to be ready kind of conceptually on how to use these tools. And they're coming. They're coming pretty fast.
Yeah, that's great. And hey, I promised a little earlier, open it up to anybody online. If you got a question, just unmute yourselves and ask. We've got Paul here for another 15 minutes or so. Any questions from anybody?
Could I ask another question?
Of
Yes.
course.
I would also love to hear from you, Paul. What are your thoughts on the statement on quote unquote value investing is dead? I'm just curious if you have any rebuttal to that, since maybe today value investing may be quote unquote harder than it might be compared to the Ben Graham days, obviously. Yeah, I'm just curious, what is your perspective on that?
Yeah, my co-author Paul Sonkin, who, by the way, is a former student of mine, a former TA of mine. We've been friends for a long time. He will tell you value investing never existed. So that's the ultimate in dead. Quick trivia comment. Ben Graham taught at Columbia Business School, started in 1927, retired in 1956. Never used the phrase value investing his entire career in his writings. He was followed by a guy named Roger Murray. I had the opportunity to write a biography of Roger Murray a couple of years ago. A lot of fun. Roger Murray taught at Columbia Business School from 1956 when Ben retired to 1977. And oh, by the way, Ben Graham's most famous student is clearly Warren Buffett. He had a few others. Roger Murray's most famous student is Mario Gabelli and Leon Cooperman, wildly successful investors. He never used the phrase value investing. Value investing is in the first book with the title Value Investing comes out in 1988, Lawrence Stein. The first time we've been able to see value investing is probably a bit before that. So it's a modern day phrase. So I just want to put this in perspective. Bruce Greenwald, who went in 1993, Roger Murray came back to New York and gave 4 90-minute lectures each Friday for 4 weeks. And a guy named Bruce Greenwald sat through the lectures and was so impressed by the structure of this thing that he relaunched. Nobody had taught the course formally from 1977 to 1992. And in 1992, Bruce launched the class, 1993, I'm sorry, 1993 launched the class again, and he coined the term value investing. So value investing is a fairly modern term. The way I think of value investing is fundamental investing. So to me, everything that is fundamental investing is a form of value investing. What a lot of people think of as value investing is really a balance sheet oriented investment approach. Ben Graham looked at that. He was very, very risk averse. His father had been wiped out in the 1906 Knickerbocker crash, and so Ben understood capital preservation. His father died when he was young. After that, he and his mother and his sister had no money, so he was very keen on capital preservation. And therefore, he oriented his early investment style that way when you could. When Buffett starts in his partnership in 1965, he was buying companies at 5 times free cash flow. Today, they don't exist. So if you want to look back and call that value investing, sure, it was fundamental investing in a market that was a lot less efficient than today's market. So now what Wall Street does, they get a little lazy. And so value investing in the definition of value investing is price to book. And so value investing stock, when the Wall Street Journal says value investing is underperformed growth investing, all they've done is taken all of the stocks in the S&P 500 and they've ranked them on a price to book basis. And those with really low price to book are value stocks, and those with really high price to book are growth stocks. And there's a lot of flaws in that. I'm assuming some of it was obvious to you. And that's what they're really talking about. So rather than saying value investing to underperform, they can say low price to book stocks have underperformed or outperformed. Low price to book stocks tend to do better when the market goes down because there's not much for them to go down. And high price to book stocks tend to do better on the market up because people are excited about investment opportunities. Now, back to your original question, value investing is dead. I don't think fundamental investing is dead. I don't think so. Market has gotten more efficient, certainly gotten more competitive. I think that's the key insight. But there is a group of investors that have outperformed and significantly outperformed in the last 20 years. And they're fundamental investors, and they have a long investment horizon. They have a lot of money too. So people are very quick to say that active money management underperforms, but there is a group of investors that have done phenomenally well, outperformed the market, significantly outperformed everybody, by the way, outperform growth, outperform value, whatever you want to do it. They have a long holding period, and they charge high fees, and that's called private equity. And so private equity is active management. Now they happen to own the whole thing. They can lever up for lots of structural reasons. And those returns, best we can tell, they're not very transparent. Those returns have outperformed. So this idea that value investing is dead, I think, is getting caught up in the definition of what value investing is.
Gotcha. Thank you so much. And may I ask a follow-up question to that?
Please. You
Thank you.
apparently have no competition, so keep going.
Okay. Okay, no, that was fantastic. Thank you. And so now follow up on that, like, as you were answering that, it made me also think on how, like, I think like recently I read an article on at WSJ or something. It was like the S&P, like PE today is like 25 versus like the historical 15. Um, and so I'm curious from your perspective, how do you recommend like us students to navigate this like quote unquote like expensive market right now? Especially also when we have like higher interest rates compared to like normal. I think it's just like a unique situation that we're in right now.
Yeah, there's two things. Number one is I would maybe try to convince you that interest rates are not higher than normal. They're higher than normal in your life. But if you have a little longer
Right,
perspective, they're sort of
right.
right where I have a fun chart that's 5,000 years of interest rates, and about 4% is the long-term interest rate. And that's where we are. So I would argue they're actually normal. The market, I think you want to separate the Meg 7, Magnificent Seven, from everything else. If you take them out, the market's not really overvalued. The Meg 7 may be overvalued, but there's something going on that you're a part of, most likely, or certainly people are part of, and that's passive investing. And passive investing, we've been trained by finance, modern finance, that active money managers don't outperform, so don't pay the fees, just buy an ETF. And people got the message. And a great statistic is in the first 20 days of the year, $145 billion went into passive investments. Now, what does a passive investing fund do when they get cash? They buy stocks. What is their price sensitivity? Nothing. They're price inelastic. They don't care what the price is. They just have to buy those stocks. So as the Meg 7 became a bigger and bigger portion of the S&P 500, the passives bought more and more of them. And so we're in this really weird cycle where, because there's so much money going into passive, because that's what everybody's been trained to do, and they buy when they get cash, they sell when they have disbursements or withdrawals, then as long as cash keeps going in, they're going to keep buying. They're price insensitive. No one wakes up and says, Nvidia's a little pricey. Should we really buy it? They don't. They buy exactly. They're replicating the index. And so as long as money goes into ETFs, the Meg 7 will continue to go up. That's almost all you need to know. And they're going to look expensive until the day they're not. So if I were you, if you want to own the Meg 7, just own an ETF and then go do your work elsewhere, because the rest of the market is not overplayed.
Sure, sure. All right. Thank you.
Yeah. Well said. I mean, to be fair, Paul's talking about cap-weighted indexes, but that's the vast majority of passive funds out there. I took a bunch of notes. I've got some questions, but I'll put them on hold. Anybody else have a question? Maybe other than Andre.
Hi, Paul.
Hey.
Hello.
Yeah.
Yep, go.
Hi, Paul. My name is Jesse. Thank you for this meeting once again. It was a great, fantastic meeting, Paul. My question to you is, any advice for a freshman graduate student who's looking for internship opportunities as an analyst for different firms? The only experience that I have right now, Paul, is just running my own little side hustle on the side. Running just a clothing brand, a small little project, small little side hustle that, I'm working towards. And what is your advice to someone who has a little bit of experience in the business world, but is looking for internship opportunities as a freshman and in this day and age?
Yeah, I think freshmen are a little tricky, but I highly encourage you to push hard. Networking is absolutely critical. Don't be afraid to ask friends, your dad, your cousin, your uncle, your professors. Ask everybody if they know anything. You want early on in your career, you just want anything that looks like it's financial services because you can put that on your resume and you're going to use that as a stepping stone for your sophomore internship. And there's no question what we care, almost everybody cares the most about is passion and hard work. And your generation has a bad reputation. I'm not saying it's true, but it has a bad reputation not wanting to work. So if you're the first one in the office and the last one out of the office every day, someone's going to notice and they're going to be impressed by that. I would argue that your generation, it's even easier to stand out than in my generation. Everybody in my generation got yelled at by their parents for not working hard enough. Your generation, they making other choices. I'm not passing judgment. I'm just saying that if I have an employee who's always there, always in a good mood, always says, yes, I would love to do it, and somebody else who shows up at 9:15, the first one out, Fridays are out a little bit, there's no question, it may not be fair, but I'm going to give it to the dedicated, hardworking person. That's just kind of how it works. As a side comment, I would get very good grades. I had kids. My kids are a little bit older. My son is in private equity. My daughter's a writer in LA, just north of you all. And I used to say to him, I said, I don't care if you get good grades, but let me just tell you, good grades create opportunities, bad grades create obstacles. Get good grades. Get good grades. It's that simple. And that's why you're there. So the side hustle is actually pretty good because that's something you can talk about on an interview. If you're interested in a certain business, learn about that business. That's the nice part is the resource between Google and ChatGPT. You can learn anything about anything. I have a friend who does this exercise. When he hears a new phrase or something he wants to learn about, he goes to ChatGPT and he says, explain this to me as if I'm in fifth grade. Then explain it to me as if I'm in high school. Then explain it to me as if I'm in college. Then explain it to me as if I'm a PhD student. And then elevate the same topic. And he slowly, slowly learns the whole thing. You can learn anything. So if you've got, all of a sudden you have an interview in the construction industry, go learn everything you can about the construction and learn everything about that company. Because in the interview, they're going to be impressed. Versus, do you know what you want to do? I want to work hard. I want an opportunity. Well, what do you know about construction? Well, this is what I've learned. Maybe it's not right. So those sorts of things can really help you stand out. And I would interview a lot. I would network with everybody you possibly and get good grades and tell you to do the impossible.
Good
Thank you,
answer.
Paul. Thank you so much.
Hey,
All right, Matthew's
thanks for
hands
the
up.
question. Yeah, we got Matthew and then Andre. Matthew.
Hey, Paul, I was sort of going off what Andre was talking about earlier. So I was curious, when you said that you thought fundamental investing wouldn't ever go away, what are your thoughts on the rise of quantitative funds with a lot of engineers and machine learning applications these days that have been showing to outperform the market? Do you think those might outcompete more fundamental based funds?
Well, you have this other group, which they're sort of the gamification of it. I've never been that impressed, but they've done some pretty serious stuff. They ultimately always get arbed out. Every trading strategy gets arbitraged away because people figure it out. But I think there will always be a role for that quantitative approach. Now, the part that's interesting is the fundamental analysts are the only ones who are setting price. Now, you could argue maybe that goes away. I don't know how your market functions if that goes away. I think you have a real problem. So I think we all have to root that fundamental analysts stay at least somewhat in the market because they're helping to set price. And then on top of that, we have passive, they do nothing. And then adjacent to that, we have the quants who are trying to play the game, looking for weird patterns. Patterns don't repeat always. They're pretty sophisticated to find these patterns. Human behavior is human behavior, so I'm sure they have found patterns. The best at that is clearly Simon's at Renaissance, and he doesn't have a single finance person on his team. They're all mathematicians and physicists because they're playing math games. great, great, great. That's never interested me that much, but that doesn't mean it's not legit. He's worth billions of dollars and I'm not. So, there are lots of ways to play the game. I'm really fascinated by that fundamental research. Will it ever go away? I don't see how you have a market function if it does. I don't know. I guess we have AI bots setting price. Maybe, maybe.
Okay, great. Thank you.
Okay, hey, Andre, your question.
Yes. Hi, Paul. Second Andre over here.
Ah, great.
Had a quick question regarding kind of a more general life direction, to be honest. So I'm currently a freshman first year, and I have my sights set on MBA later down the line, and I am interested in doing it for entrepreneurship. I already have my own startup right now that I'm working on. I was wondering if you have any kind of advice other than, the classic leadership positions, setting your intent on being focused on the business, all that stuff that you have for maybe someone in my position.
Um, yeah, I love entrepreneurs. We watch way too much Shark Tank. My wife really likes it. But I just, I mean, there's a passion and a dedication, devotion that's pretty neat. Some of them are shockingly unrealistic. But many of them you're like, wow, that is clever. That's really pretty clever. I think that if you're young, I'm gonna give you an answer that sounds contradictory in the answer. One, definitely get good grades. You got to. I just can't stress it. And take as much risk as you can in the business world. I'm not saying do dumb, crazy stuff, but go start it, let it fail, start another one, have it fail, start another one, have it fail. I just think those reps are invaluable in terms of maturity and business and understanding how hard it is. But I think that probably as a classic line, as you get older, you look back, you wish you'd taken more chances. And I think that's true. And so that's why I say do everything you can to get good grades. And the barbell approach is then, so that's your risk reduction because you have good grades that will create opportunities, graduate school and jobs, and then go take as much risk. Go try that startup and have it fail, and learn. And I think at the end, I'm a big believer in postmortems. What could you have done differently? Don't beat yourself up, but just keep a journal and keep going and then do the next one, do the next one. And uh, that energy, passion, experience, and good grades, someone is going to want to hire you. They're going to say, hey, wait a minute. I want Andre to work for me. He's pretty cool.
Perfect. Thank you so much.
Andre, one other thing I want to share, and then I want to jump to Matthew. Earlier, I mentioned I run the Brandis Center on campus here, and there's another handsome bald guy, Tim Schwartz, that you might want to reach out to. That wasn't supposed to be that funny. Yes, it was. Yes, it
I
was.
liked it. I liked it. Worked on me.
Tim Schwartz, who directs the Sullivan Center. Are you familiar with the Sullivan Center?
Yes, I've heard of it.
Okay, so if you haven't reached out to him, reach out. And one of the key points Paul's talked about is networking. So just continue to build your network.
Okay, Tim Schwartz, you said.
Yes, at the Sullivan Center. And you can tell him, hey, Bob sent me, and then he'll come over and punch me in the nose.
Perfect. Thank you. Thank you very much.
Of course. Hey, Matthew, Tran, question.
Yes, of course. Paul, I want to thank you for your time and your fascinating idea for like pitching the narrative. And I wanted to expand on that. Throughout your career, have you ever encountered any pitch that like stuck out to you, particularly where like the story behind the stock was so strong that it just convinced investors despite any initial skepticism?
It's very hard. Yeah, very hard to answer. These are all internal. I ran a small hedge fund for 10 years, but we had 3 investments that were just, I would say, no-brainers. One was a tech company traded at 10 times earnings. People couldn't understand it. There was some hair on it. It was in the dental business, technology in the dental business. But we started doing digging. It was like, this is free money. We bought 10% of the company, and stock performed unbelievably well and then got bought out. The second one was a healthcare company in Florida that was run by a really great CEO, bad board. We ultimately changed the board, but traded at 5 times free cash flow. And I have an argument. I will make a statement that if you can get any confidence in the duration of cash flow, you'll always make money in a stock that trades at 5 times free cash flow as a 20% implied cash yield. That was one that we rode for a very long time. 7 years. And it never traded much above 5 times free cash flow. They just grew the cash flow every year at a very rapid rate, and then ultimately got bought out. And then the third was a software company based in Canada. And it had the Canada discount. And the more we looked at it, the more we were like, in the US, this would trade 3 times higher. And that was one we ultimately sold it, but we made a fair amount of money. So yeah, you do see them. When you see them, they're pretty obvious. You're scrambling to make sure you didn't miss something, because sometimes the obvious ones have something that really is obviously why they're cheap. In all three of those, we couldn't find anything, and we made a lot of money. So yeah, Buffett always says that you'll see 20 of those in your career. That may be true. I've only seen 5 or 6, so I'm hoping maybe I have another 10. But yeah, and the pitch is easy. The easier the better the idea, the easier the pitch. If it's the more complicated the pitch is, the less good the idea is. So if you find yourself coming up with all kinds of crazy things that have to happen for the stock to work, move on to the next one.
I see. Thank you so much, Paul.
Hey, Paul, can we keep you around for one more
Yeah,
question?
absolutely, absolutely.
And if nobody has one, I've got one for you, but I'm happy to put that aside. Any other questions? Y'all been great jumping in here. This is exactly what we wanted, a conversation rather than a presentation.
I have a very
Yeah.
quick question. It's not even that big of a deal. I'm just curious, are you gonna go to the Berkshire conference this year, Paul?
Yes.
Okay, perfect. Hopefully I'll be able to run into you there.
Oh, please do. We're having an event. It looks like on Saturday afternoon. There'll be more details.
Oh, sure, okay.
So as we get closer, send me an email. Bob knows how to get a hold of me. I'll force you to go meet Bob, which I like. Send me an email and I'll give you the information.
Okay, great. Thank you.
And on that front, I'll just dump the Brandis Center email in the chat. And while I'm at it, I'll also put my email in the chat as well. So feel free to reach out to me however you would like. Paul, have you got?
And there is a wait, before you go, there is a free copy of the deck if you want it.
Okay.
All right, ask your question, Mom. I'm so excited now.
Hey, the one thing you had mentioned, I want to just circle back real quick on pitching, because I think communication is so important in every industry, and particularly the investment industry. You had said you don't want to try and sell somebody on your idea. What did you mean by that? And can you share an example?
Yeah, it's funny because when I wrote pitch, we thought it was obvious that you go into the portfolio manager and you say, hey, here's this opportunity to make a lot of money. I got pushback after we published. I got pushback from 3 people that I respect in the industry very quickly that said, I wish I hadn't used the word pitch. And I was like, wait, what? 4 years later, why? And they said, because I don't like being sold. I said, you mean like used car salesman kind of? And yeah, exactly. I don't like the analysts coming in and just, boss, you got to buy it, you got to buy it, you got to buy it. You never know, we're going to miss this opportunity, blah, blah, blah. It doesn't like that chatter of, hey, we're going to miss it, that FOMO, fear of missing out, or that scarcity factor. There's only one car like this, only one stock. We're really ready. He said, I don't want any of that selling. Hey, boss, you got to move, you got to move, you got to move, that chatter. He said, what I want you to do is lay out why the market's wrong. And I said, oh, well, that's what we tried to imply. And so for some people in the industry, pitching feels like selling. Hey, I'm that Chuckster. I'm that. I'm selling you the elixir that's going to make everything. We now have this all back in the country. We have all this with social media. You got all this crap. He said. So I had 3 people tell me that fairly quickly after the book came out, and so I was like, I had never thought of that, and so that's why I've kind of add that back, which is, you're not trying to sell. You're trying to present in a cogent way why the stock's mispriced and why there's an investment opportunity. For me, that's pitching. But for some people, that pitching sounds like selling, of trying to force you to do something just maybe emotionally driven or something like that.
That reminds me, when I was a broker, this is like 30 some years ago, I had a wholesaler come to me and say, and I could poke some holes in this, but I think it's accurate. Selling is trying to make somebody want what you have, but good marketing is having what that person needs.
Oh, I like that.
And then you're just sharing the key points about that. And with what you've shared, if you do the research, if you understand what the portfolio manager he or she is looking for, you'll have what they need. And then you talk about it and they'll naturally want to buy it. So it's just that fine line. And it also reminds me of what you said earlier. The way to get good at this is to practice doing it.
Oh, for sure.
You just got to keep doing it in stock pitch competitions, pitching to your friends, pitching to your professors, pitch to me if you want. Just reach out. I mean, these are classes that I teach at the Rady School. So
It's interesting. I often use athletics as an example just because it's easy to point to. Kobe Bryant unfortunately died of a tragic death. But every summer he had to make 10,000 shots, not take 10,000 shots. The ball had to go through the hoop 10,000 times before his summer training was done. And that discipline to be the best, I just reminded of that if you want to be the best, you just got to do the rep. You got to keep doing it. Now, I'm going to sing Bob's praise for a second. I sent him an early presentation of this, and he found a grammatical error, which in PowerPoint's weird because a lot of people take liberty, and I changed it because I thought that was right. I don't know if you saw the corrected error that you had pointed out, Bob.
I did not.
Oh, then I'm even more excited because then it's less obvious. No, so I just that level of excellence, that level of practice, that level of caring, that's what distinguishes you over time, and never stop doing that. If you're putting your name on something, you want to be really proud of it. You really want to be proud of it a few years later.
Well said. Hey, and with that, we're going to wrap things up. Paul, thank you. Thank you so much for sharing your insights. Everybody, thanks for joining us on the call. And as I said, my email is in the chat. Feel free to reach out. We're here. Your other professors are all here to help you. And just one little pitch for the Brandis Center. We've got an event coming up the end of March. I think it's the 27th, where we've got two experts who will be talking about technology stocks in China. So if you're interested in that, send me an email. I'll get the information out to you. So again, Paul, thank you so much. Thanks everybody for joining us. And with that, we'll say goodbye.
Excellent. Thanks, everybody.